It doesn't seem like there's any any nervousness. I mean, you can see it in the sentiment on social media, right? It's like, and we are now at the stage of the cycle where the bulls who have in quotes been right, and really they've only been right based on the indexes, not based on small caps and most things, which again are still after inflation doing terrible relative to 2021 respective highs. We're getting to the point where there's a hell of a lot of, I would argue, beating of the chest, arrogance, look how great we've done type of sentiment out there. And I would remind people that hubris, and I've been through this in my own career, occurs before you start to fall. Right? It's when you feel like you're walking on water that you start to sink. For whatever it's worth, I just think anecdotally we're seeing a lot of that. Now, again, that's not a timing, argument. It's just saying that we're clearly at a level where people are all on the same side of the boat. And look, the crowd is right on average, just not at the extreme. So the only question that matters is, are we at an extreme? Markets being at new highs is not a definition of an extreme. People being all in on markets is by definition an extreme. And there's all kinds of interesting stats that do suggest that when you look at household asset exposure to equities, you look at optimism, sentiment, we're kind of at that point where mean reversion might kick in.
It's an interesting topic. Like, the market makes me really nervous. The S&P 500 the last 2 years up 24-25% each. 2022 was a bit of a different year. A lot of different impulses there. Minus 20% for the S&P, but the years before, again, plus 20%, almost 25% each year. Like, can we expect the same now in 2025? It's like we get used to it, right? Like, we're being treated like it seems too easy to make money in this market.
Yeah,
right?
what's interesting about this is that it's no different than the arguments around how whatever generation it is the most entitled generation out there. Whatever I don't know what their generation is, like the younger traders, right? It's like everyone thinks they're owed 20% annualized returns, that they're owed the market keeps going higher, that they are so intelligent based on some squigglies they put on a chart, which are really just being driven by 7 stocks largely, that they think they're owed those types of returns. It's like, you're not owed anything, right? It's just these moves happened in 98, 99. Remind me what happened in 2000. Doesn't mean you have to collapse like what happened in 2000, but, there's a hell of a lot of recency bias that's going on now. Like a shocking amount of recency bias. And when everybody thinks the same way, it's probably time to think differently. Again, I don't know when I've been wrong on a credit event. I've made that very clear. I'd argue, have been right and wrong on the reverse carry trade. It worked for 2 days. I then said Monday, August 5th, that they're going to rally the hell out of the market. I still think the reverse carry trade risk is out there. It can happen overnight, like it already did, right? But outside of that, it's like I was on another podcast, and the podcaster said, because that's like the impression out there, you've been bearish on stocks for a long time. No, I haven't been bearish on stocks for a long time. I said at the end of 2023, I expected a credit event, which never happened. Then I argued for gold and utilities, and those crushed it since October of 2023. But I said it's not that I'm bearish on stocks. It's that I'm bullish on a tail event. I think we are way overdue for an extreme decline. Okay? And that doesn't mean it has to stay down. I don't know why people get so offended by the idea that stocks can have a big decline out of nowhere. Shouldn't you want that if you're an investor? Shouldn't you want to be able to buy low? I mean, I fail to understand how people think, if they're truly trying to generate wealth, if they think stocks go up forever, meanwhile they average up when they should really be averaging down.
Yeah, dollar cost averaging, I think, is the word here. It's an interesting perspective. Like, just sort of maybe summarizing what you just said, Michael, here. Last 10 minutes we discussed Russell 2000 over S&P 500 in 2025.
I would love to see it. And again, I go back to maybe deregulation ends up being the catalyst for that. Look, the only thing that differentiates largely large caps versus small caps as far as the drivers of momentum is tech. Right? I mean, large caps are being driven entirely by the tech play. Small caps, as a part of the marketplace, tend to not have that much tech. So, to the extent that small caps rally, you need to have tech leadership stop, which is not stopping, clearly, at least to start 2025. I would love to see small caps run. I keep saying small caps hold the key. If small caps run, it means credit spreads were right all along by being as tight as they are. That there's no default risk, whereas small caps have been saying there's default risk by the very nature of the fact that zombie companies are holding back the Russell 2000. yes, there is a possibility that small caps rip this year. Absolutely have massive, massive outperformance. The only caveat to that is typically small caps outperform in bear markets. Or outperform meaning up more or down less. They'd be down less because they've already discounted a lot of relative weakness. But if you're going to say, what would you rather allocate to? I'd rather allocate to anything outside of the S&P if you're going to be long only equities. Go into international, go into small caps. I mean, typically the old leaders get old and then something else emerges. The leaders become laggards, the laggards become leaders, hence the lead lag report.
Yeah, talk about lead lag report. I was going to ask you about inflation, and maybe we should attack it from the angle of the Trump tariffs or proposed tariffs here as well. Like, what do you expect the impact to be in 2025? I know it's a lot of speculation. We're recording exactly 2 weeks before the inauguration, of course, so kind of tough to make a really 100% clear prediction here. But given your expertise and what the charts maybe you're telling you here, Michael, what do you expect is going to be the impact?
I know everyone assumes the tariffs are going to be inflationary. They likely would be, but again, I go back to magnitude, how pervasive, and then what other countering factors are there. I mean, if the market were to have a hissy fit over tariffs, then I can almost guarantee you that Trump would walk it back because he loves the S&P, he loves stocks. He rang the bell pretty much at what looked like a top for a moment in time at the New York Stock Exchange. So I don't know. I mean, the inflation argument, I think it's very clear that the inflationary pressure is still very much remains, and it remains because the Fed stupidly lowered rates with credit spreads near all-time lows. That never made sense to me. Why would you start a cutting cycle when credit spreads are telling you there's no stress, right? So small caps have been saying there's stress, but the bond market has not. Right? And candidly, that's been sort of the major error that I made the last year and a half, 2 years of my macro framework, which is that I assumed or thought logically, at least I thought logically, that the fastest rate hike cycle in history would have a lagged effect that caused, some kind of massive disruption. It did momentarily with the regional banks. And then the Fed, again, kept on draining liquidity as Yellen and the Treasury kept on putting it back to the system. So the net effect was what? Easy financial conditions. I never thought that you'd be in a situation where the government is countering the Fed, but that's exactly what's happened.